Welcome, everybody, to another episode of SAV Live. My name is Kai Hoffmann. I'm the @Junior Mining Guy on Twitter and the CEO of the Soar Financial Group. Thank you for joining us. Really appreciate it. And we have a special guest and a fantastic guest, actually, on the program today. It's Rick Rule. I don't think he needs a lot of introduction, but he recently went independent. He left Sprott, and he's just an investor and speculator now. He manages his own money or family office money, and really excited to have him on to discuss what is happening in the macro space, what is happening in the US. How is that trickling down into the junior markets? Really want to pick his brain on what he thinks is happening in the fall. Personally, I'm quite positive, but curious if he sort of agrees with me or what he's looking for in the fall as well. But before I switch over to my guest, please follow us on Twitter and YouTube, of course, as well. Hit that like and subscribe button. And if you hit that little bell icon as well, you will get push notifications to your screen sent either on the phone or in the browser, and you can just jump right into the videos that we're uploading, which we hope are really useful to you. Let us know in the comments if they're useful as well, and if you have any questions, please post them there as well. Now, I've said enough, and I'm really excited to welcome back Rick Rule. Rick, thank you so much for your time. Good morning.
Kai, it's always a pleasure to be on with you. Thank you for having me back.
Oh, of course. Like, how could I pass up that opportunity? I really appreciate it. And Rick, I'm going to dive right into the questions here, not wasting any time. And when I was preparing for this interview, I looked on LinkedIn to see what kind of title you gave yourself after you left Sprott, and you chose investor and speculator. And that brought the question to mind is like, how do you differentiate and where do you draw the line between an investor and speculator? Where's your risk?
I was taught in university, and I believe today, that the practical difference between an investor and a speculator is that an investor allocates capital based on the reasonable expectation, in fact, the probability of acceptable rates of return. A speculator takes greater risk. He or she allocates capital based on the possibility as opposed to the probability of excess rates of return that aren't available to investors. I am, in fact, both an investor, which is to say I allocate capital in circumstances where my return expectations are around probabilities, and therefore the potential payoffs are lower, but of higher probability. And I'm also a speculator, which is to say I'm willing to take substantial risks for outsized gains. Many people who have listened to my past presentations will note that I often tease speculators. My wife notes that I made all of the money that I now invest sensibly by speculating wildly.
Where do you draw the line? Do you have a hard line in the sand where you become a speculator versus an investor? Because everybody's got a different risk tolerance and profile, obviously.
I'm lucky in that I'm 69 years of age. I've been doing this for a very long time, fairly successfully, and I have the ability, the financial ability, to do both. And I do both. I look at the risk and reward offered up in both investments and speculations, and I gear myself to what I see as the relative risk-related returns offered up on both sides. For the last 3 years, given what I saw as ludicrous overvaluations in the junior sector, I found myself being more of an investor than a speculator. If I thought, as an example, that Exxon could double or triple, why would I care too much about amalgamated orangutan petroleums? Now we're in a circumstance where what I see as the best of the juniors, that's sort of 150 out of 3,000 companies worldwide, that I see as the best of the best in the sub 250 million market cap space. Now that I see those stocks haven't fallen 50 or 60%, I find myself drawn much more to speculation. So I'm willing to go, if you will, risk on in a world where most of my competitors have gone risk off.
Yeah, most of them have actually gone cash, I think, as well, from what I'm looking at the volumes. So I think they completely disappeared from the market, many of them at least. Rick, I think I mentioned in the intro, let's touch on the macro first before we talk micro and what kind of juniors you consider as part of the 150. But I think a good way to talk macro, or a good segue, is to talk about the sentiment at your recent conference that you held in Boca Raton. So I'm really curious how it went, but also like what was the mood? Like what were some of the topics discussed? I'm sure inflation was number one.
Well, first of all, I need to say that I don't think that the sentiment at my conference was indicative of the broad mood. I think my audience self-selects. The Natural Resources Investment Symposium in Boca Raton was, I think, the 30th consecutive Natural Resources Investment Symposium. 2 of them were done virtually. So I think that both the audience and the exhibitors self-selected. Exhibitors self-selected because the qualification to exhibit wasn't merely a check that cashes, which it is at most investment symposiums, but rather you had to be owned in an account that I own or I manage, meaning that I had vetted these companies well enough that I owned them. The audience, too, self-selected. My audience traditionally is a contrarian, value-oriented audience. And I think that the deep level of engagement that we saw at the audience is a consequence that this self-selected group of investors felt very much at home in a circumstance where other investors and speculators in the segment felt only despair.
Yeah, no, that's a good point. Like despair, I think we feel it left, right, and center. And jobs report, CPI number, PPI numbers, they're all looking horrible. But at a conference like this, yes, like did you see more response? Like you said, like it was the 30th conference. Congratulations, by the way. But like, I'm trying to figure out, like you saying they're contrarian investors, so you should have had like, and I don't want to hear total numbers or so. But I'm just curious, like, did you see an influx of investors that are more interested this time?
Yes, in fact. And in terms of numbers, we had just under 500 total. That includes speakers, it includes employees, it includes exhibitors, it includes attendees. So just under 500 total. So based on some of our past years, the attendance was very modest. Understand that this is a conference that we charge attendees for. It's not one of these, sort of, freeloading,
Yeah, I can't
anyway.
grab any pens there, eh?
Yeah. But the level of engagement was extraordinary. What was also extraordinary, Kai, over the last 5 years is that the median age of the attendees has probably fallen by 2 decades.
Wow.
I used to joke that my audience looked like me, old, fat, white, rich, bald. That's not what the audience looks like anymore. The audience was probably 25 or 30% female.
Wow.
The audience was substantially younger. There was a larger contingent from Latin America. There was a larger contingent from Europe. What was particularly heartening for me is that, and maybe because I asked them to, everybody came to work. The workshops were packed. The attendees were using the lessons that were imparted from the dais in real time on the attendees. The level of engagement was very, very, very heartening.
No, fantastic. Okay, no, that's great to hear. Like, because that's what we want to hear. Like, because we live in a very difficult time, and I'm interviewing a lot of guests lately, talking macro, and I'm still trying to make sense of what is happening and what has happened and what is going to happen. Right? It doesn't feel like it's following any rule books anymore, and the economy is just sort of like a sidewinder snake, just going wherever it needs to go. But trying to put it into perspective now. So you mentioned that the TSX Venture Minor Index is down 60%. Many of the stocks have been absolutely pummeled. What do you blame for? Like, what are some of the reasons you see for that? Of course, outflow of capital. But what are some of the main drivers for that? And that sort of paints the picture of where we're at right now, I think.
Well, we could do a whole interview on that.
How much time do you have, right?
Yeah. Well, first of all, if you look at the whole universe of junior stocks worldwide, maybe there's 3,000 of them, 2,500. Yeah. 90% are valueless. They have no value whatsoever. But they had prices a year and a half ago. If you merged every junior company in the world into one company, Junior Explorco, that company would lose $2 billion in a bad year and $6 billion in a good year. So what do you pay for an industry that destroys $2 billion a year in capital? The right answer is nothing. That belies the fact that probably 10% of the issuers, so maybe 300 companies, generate such performance that they add legitimacy and luster to a sector which destroys $2 billion a year. This really, truly is an amalgam of the good, the bad, and the ugly. So your job is to find the good. Mercifully for me, in the last 12 months, the prices of the good, the bad, and the ugly have declined without sort of reflecting the underlying characteristics of the company. So that 60 companies that I follow closely and 150 companies that I and or my former employer, Sprott, follow, have uniformly declined in price to the extent where I think that the risk-reward juxtaposition is attractive from my own point of view. Why did this happen? Well, in the first sense, as I say, the sector was valueless as a whole sector, and was 12 months ago, I think, uniformly overpriced. That's all changed. For me, the price of risk relative to the opportunity as I see it is the whole equation.
Yeah, interesting. Yeah. Okay. So I've noticed, like we track also financings in the junior mining sector, right? With Warrants Inc. And we raised $6.8 billion in 2021 for companies below $1 billion market cap and financings below $100 million. That's a lot of money. That's the second highest level since 2011.
Yep.
Right. But it feels like we got nothing to show for. Right. Besides Philo, not a lot of discoveries come to mind. Right? Maybe because Philo is overshadowing everything else because it's been such a gigantic success. But in my mind, I haven't seen much. I've seen a lot of infill drilling, but not a lot of exploration drilling. Are we allocating capital the right way?
No. Some years ago, probably 15 years ago, we had a young intern. That's finance speak for slave. And I asked him to pull 25 TSXV juniors at random, look at the balance sheet and income statement, and tell me what he saw that was profound. He asked me what to be looking for, and I was actually looking for the way he thinks. And so I said, I'm not going to tell you. In truth, I didn't know what he was looking for. I just wanted to see how he thought. He called me back about 2 weeks later and says, okay, I've got it. I said, really? What do you have? He said, well, of 25 companies that I pulled at random, the mean expenditure on G&A was over 65% of cash raised, which is to say, and I'm not trying to say that 25 is a representative sample, but out of 25 companies that he sampled, the mean allocation to general and administrative, non-field expense, was 65%. If that number holds true, out of the $6 billion that you refer to being raised, 4.5 billion of it didn't go into exploration. If you look at something that would be a representative net exploration expenditure, which is to say $1.5 billion, and understand too that district scale exploration usually takes 10 years to be a success, you can reasonably expect that without $15 billion being spent over a decade, you don't have any right to expect success. When you look at the success in Philo that occurred last year, it didn't occur last year. It occurred beginning 25 years ago when the Lundin family recruited Patricio Jones and Martinez and that whole crew. They have been involved in systematic exploration on the Argentine side of the Andes for 25 years, which is to say that the Lundin family has now worked 25 years to enjoy the overnight success that happened last year. At this point in time, by way in the interview, I think you and I should both acknowledge the wonderful contributions to our net worth and our industry offered up by Lucas Lundin, the recently deceased superstar, successor superstar in the Lundin family, but also acknowledge the 6 Lundins currently active in the business.
No, absolutely. All of the companies, whether it being Bluestone, Philo, Lundin Mining, those are, run also by his children. So really worth taking a closer look because I think he's done a fantastic job raising them. At the opportunity, I think Adam I interviewed on SF Live before as well. Fantastic
Right.
chap. So we raised $6.8 billion, and but I've noticed also this March 16th, cash flow, or not cash flow, but flow of funds into junior mining completely dried up, right? It's completely disappeared. That was also the day of the first Fed rate hike, by the way, right? So it sort of coincided. What do you see happening now, maybe looking forward a bit as well? It seems like, or rumor has it, that the Fed might pivot a little bit at their next meeting in September. But do you see funds then return into the sector? And what do you make of, or what do you see the correlation there between junior mining and the Fed fund rate? I find it interesting.
Well, certainly I hope they don't. Certainly I hope that the flow of funds into mining deteriorates much more substantially. Understand that I'm a provider of capital. And even an old fat bald guy like me, Kai, can win the race if I'm the only guy who shows up to run. So while you, as a younger person, as a trader, might want to see instant gratification that would come from flow of funds, an old check writer like me wants no competition in the sector. So for me, the flow of funds is one of the things, the lack of the flow of funds is one of the things that attracts me to the sector. Going back perhaps to the intent of the question, I believe that the American voter believes that the American economy is strong enough that the Fed can continue to allow interest rates to rise. I'll note at least that some of the fiscal policy that's being reported to Americans is a sham. The end of quantitative easing, the so-called taper, is not occurring. While the Fed is not as active in the Treasury market as they used to be, they're buying mortgage-backed securities. They're supporting the mortgage market with counterfeit currency. They aren't borrowing the money to do it. They're in fact printing it. Negative real interest rates, too, are obviously not a natural phenomenon. They're a construct of the Fed. But I believe that confidence in the economy is still strong enough that the Fed isn't going to have to back off allowing interest rates to rise. Note that interest rates are still, real interest rates, decidedly negative. The U.S. 2-year and the U.S. 10-year trading at about a 300 basis point yield in a currency that's declining by 900 basis points a year. The fact that we have confidence in the economy when the distortion between narrative and math is that aggressive is very impressive for me. Nonetheless, the market works the way the market does. I expect that the Fed in the near term will be able to continue with at least one, perhaps two more interest rate rises. A bigger question, Kai, is because we're all going to be here, or most of us are going to be here 5 years from now, what happens between now and then? If you look back over the last 40 years in history, Kai, for most of that time, the U.S. 10-year Treasury has had a nominal real yield, which is to say that it has yielded in excess of the CPI stated rate of inflation. Were we to have reversion to mean, that would mean that the interest rate of the U.S. 10-year Treasury would have to increase from its current 3 and change to 9 and change. Now, the impact of a real yield, the impact of a return to mean, would mean a quadrupling of the interest payable on debt, be it federal, state, and local debt, consumer debt, or corporate debt. That would have an interesting impact, I think, on equity markets. Going beyond that, for your American audience, I realize you have an international audience, but from an American audience, the U.S. 30-year mortgage rate has yielded in excess of the U.S. 10-year Treasury rate, which would mean that the U.S. 30-year mortgage rate would increase from something with a 4 handle, a low 4 handle, to something with a mid-10 handle. Can you imagine the price of single-family homes in the United States if we had a 10.5% first mortgage? So I think ultimately what happens is that the Fed plays chicken with interest rates until the borrower, the voter, screams in pain. And if that happens and the Fed backs off the increase in interest rate, I think you'll see a response in the market that will take your head off.
Interesting point. And now is like a follow-up question to that as well. Like the Senate just passed the Inflation Reduction Act, which is like the name itself, we can argue all day long about it. It just doesn't make any freaking sense. But like you mentioned easing of pain. I just looked at it this morning, what's included in that, and it's supposed to cap Medicare costs and costs for medicine and stuff for consumers just to ease the pain a little bit. But $300 billion of that is going straight to pay down federal debt. So it just disappears again. Like, it doesn't make any sense. But $375 billion is supposed to be designated to fight climate crisis. Right. I got to now circle back a little bit. A, like, what do you think of that package? And B, we're coming from the mining side. Do you think we'll have any benefit of that?
Answer to the last question's easy. No. I mean, there may be a handout to the nuclear industry, something like that. But let's go through this bill just for laughs. And let's preface it by that wonderful statement from H.L. Mencken. Elections are advanced auctions of stolen property. This was the lobbyists' enhancement bill of 2022. You'll notice that the potential benefits to taxpayers and shareholders are backloaded. They're projected to occur 8 or 10 years from now, pardon me.
Yes.
While the gifts, the subsidies to various industries, take place this year. I will gladly eat that hamburger today if I can pay you next Tuesday comes immediately to mind. The Inflation Protection Act as a spending bill, title for a spending bill. I mean, what can I say? It actually reminds me of a different quote, this time from Ambrose Bierce, I think it is, in the Devil's Dictionary, who says, you can tell politics by looking at the origin of the word. Poly from the Greek for many, and tick from the English colloquial for small, blood-sucking insect. If you look at this bill, you will see the relative importance of various classifications of small, blood-sucking insects in Washington.
Absolutely. And I'm just looking at tax rebates for new and used EVs, for example, and those are best examples for that. So again, the miners won't see any change. Like, that also brings me a bit to political risk, right? Because you'd think that when the US passes an Inflation Reduction Act that's supposed to fight climate crisis, that maybe they'll approve the odd project domestically to sort of help with that crisis, right?
You will notice that at the same time that the administration and Congress are paying lip service to new metals production, that the Resolution copper deposit, an absolutely world-class copper deposit, over 1 billion tons of reserves and resources at 3 times the average mined head grade worldwide, has been in the permitting process for 20 years. You'll notice, too, that despite local support and indigenous person support for the Trilogy Copper Project in Alaska, that the Biden administration and Congress has closed down the access road. Understand that what you see in American politics, and probably politics worldwide, is the triumph of narrative and interest over arithmetic. If you are looking for substance in politics, it's because you spend too much time listening to or reading the mainstream media. There is none.
Absolutely. Rio 2 comes to mind as well,
Right.
having their permit more or less pulled to build their Phoenix Gold project in Chile. So when looking at now at the 150 juniors or the 60 that you're invested in, like, has your political risk profile changed? Have you sort of killed certain jurisdiction in your mind as investment criteria?
I don't kill any jurisdiction. I find myself that I have been treated as an investor better in Congo than I was in California. It's odd that people who look like me somehow believe, in terms of political risk, that's money stolen from us by people who look like us, old, fat, bald, white people, who steal the money in English according to the rule of law through the legislature, are somehow less risky than money that's stolen from us in other fashions. It's interesting, too, that people who assess political risk don't understand the very real sense in which a campaign contribution, at least a bundled campaign contribution, is a bribe. I believe that societies that can't get any worse often get better, and that societies that can't get much better often get worse. And so, while I believe that the world is becoming more political, that more and more issues are being decided socially rather than arithmetically or by utility, and so I believe that political risk is escalating around the world, what's important to me is the cover charge, how much I get paid to assume the risk. And the market capitalizations of tier 1 deposits in countries that are believed to be politically risky by people who look like me are often so low relative to the market capitalization of tier 3 deposits in countries where we feel comfortable and can pronounce them and spell them, that I find myself more commonly drawn to frontier and emerging markets jurisdictions than major market jurisdictions. Mercifully, we come into a situation like 2022, and there are a few deposits in countries that my competitors will ultimately feel comfortable about when they return to the market. that I can invest in today at a premium that isn't, to me, obnoxious.
No, that makes a lot of sense. Do you want to share a couple names to sort of wrap up the conversation? I think maybe a couple ideas that you have on your radar if you want to share them. But
certainly names I've been buying include sovereign metals, really, I think, amazing rare earths, rutile, and graphite discovery in Malawi, a place that, by the way, has some real risks. I would suggest the Lundin vehicle, Africa Oil, is pathetically cheap. I think it's selling at half the price of their Nigerian assets. You get the Kenyan discovery for free. You get a direct and indirect participation in a world-scale discovery in South Africa and a separate world-scale discovery in Namibia for free. And you get it in the Lundin wrapper. I continue to be attracted to an Australian-listed name, Centaurus, which has what I believe to be a potentially tier one, it isn't yet, a potentially tier one nickel, platinum, and palladium discovery in Brazil. But those, I've just given you ones that I've been buying recently. The junior universe has gone from universally uncompelling to universally attractive. If you have me on 6 months from now, which I hope you do, I think the big change between that interview and the next interview is that I will have likely allocated between $5 and $10 million personally to private placements in juniors. This whole flow of funds away from the juniors that we are seeing is presenting an opportunity. Many juniors played chicken with capital markets, thinking their share prices would rise, and they could raise the capital that they needed with less dilution. And they lost the bet. They're going to have to raise the capital, and they're going to have to raise capital in a market where there are fewer capital providers. I would urge them to call Rick Rule, provided, of course, that they can still spell warrant.
Exactly. 5 years full warrants. That's the game. At least, might as well take advantage of the situation. I'm absolutely with you. Right. So makes a lot of sense.
Given the arithmetic around junior exploration, given the probability of failure, given the population historically of successful rather than unsuccessful companies, warrants are always fair. I've always wondered, Kai, and perhaps you can help me with this. You're young and smart. You don't have to wear a tie to look legitimate. But what's the difference between a warrant and an option? Companies say that warrants are dilutive. Companies say that warrants should have 18-month terms, but options have 5-year terms, and they can be reset if the price of the share falls. What's the difference between a warrant and an option? I'll tell you what it is, Kai. A warrant I get, an option they get. That's the only difference. Managers tell me, well, that's fair because I work at the company, you don't. And I say, you're right, that's not fair. My money works there 7 days a week and you only work there 5. So I ought to get 7/12 of the benefit and you ought to get 5/12. Is there something wrong with that thinking?
No, not necessarily. No, because you're enabling them to actually generate that return. So no, I'm fully with you. It's like, as an investor, I love warrants. 5-year, 10-cent warrants, paper me up. Seriously. Now we'll start a Rick Rule Index and start tracking your placements. So I hope the companies press release your presence like they did with Eric Sprott back in May 2019. So be fun to watch. Rick, thank you so much for your time. It's been a fantastic conversation. I hope it was a bit some original content in there. I felt like I learned something new and really appreciate it. Thank you so much for your time and coming on. And by the way, before we forget, please send in your questions to either Rick or go visit the website, Rick Rule Investment Media, because Rick does profile rankings.
Actually, Rule Investment Media.
Sorry.
Sorry.
Nope.
Rule Investment Media. Any of your listeners who are amused by what I had to say or interested can hear more. And more about things that are of specific interest to them. If your listeners go to ruleinvestmentmedia.com and they list their natural resource stocks, please no crypto stocks, please no tech stocks, please no pot stocks. I'll rank them if I know them, 1 to 10, 1 being best, 10 being worst. I'll comment on individual issues if I think my comments have value. And for those listeners who are accredited, I will distribute for free a list of the private placements that I'm participating in. It's not solicitation anymore because I'm not licensed. I'm not soliciting. I'm just telling you what I do. No guarantee if I go to placement that you'll be allowed to, but I will let you know for free. at ruralinvestmentmedia.com on the rankings database in the question and comment section. Just ask for questions. Finally, Kai, we talked about my symposium. We'll forward you a link that your listeners can go to. The whole symposium plus more will be available online in a virtual symposium starting August 12th. Charges $99. Any listener who pays the $99 and doesn't think they got their money's worth can email me and I'll give them a full refund. Every investor education product I've done for the last 30 years has come with a full, no conditions, money-back guarantee. Mercifully, in 30 years, I've had to refund less than 0.1% of the fees raised.
Fantastic, Rick. No, great value add. I've heard great things about the Rick Rule Symposium. So, and from people that were there and listened to the presentation from Robert Friedland, for example. Great content. Thank you so much. Thank you for your time, and we'll have you back in 6 months.
Always a pleasure. Thank you.
Thank you so much. And everybody else, before I forget, please follow us on YouTube, follow us on Twitter, hit that like and subscribe button, and leave a comment. We want to hear from you. And yeah, thanks so much for your time. We'll be back with more content soon.